so if you think about it, if you had a business that was an all cash business, meaning people paid you cash at the moment of all sales transactions, and you paid your suppliers at the moment of any transaction of purchasing for them, and there was never any accounts receivable, never any accounts payable, never any notes receivable or notes payable, and you never purchased big assets like buildings or equipment, then your income statement would match your cash flow perfectly, because all revenues coming in would be cash, all expenses going out would be cash, and so you would know exactly how much cash is coming and going. But the way we do business, right now is we have things like people buy something from us and we tell them, oh, you can pay me for it in 60 days. So we recorded it as revenue, but at the end of the month, the revenue that's showing on our income statement hasn't all been paid to us in cash. So our revenues won't match up with our cash inflows, the money coming in. We have expenses where we're told you can pay for that later. So our expenses won't always match up with the cash outflow. We have assets that we purchased 10 years ago that we paid cash for, but we're still taking depreciation expense for them today. So we have this expense. It would look like we have less cash, but actually no cash was spent during this year for it. All the cash was spent in a previous period. So all these things lead to having differences between our net income, revenue minus expenses, and our cash flow, how much cash has come in and gone out. And so this is what makes this hard. Again, if you think about it, if all accounting were cash-based accounting, then it'd probably be easier for the accountant. Most of what makes this class hard is all of these accrual concepts, this idea of dealing with the fact that I have revenue where I didn't pay cash, or I got cash ahead of revenue, and having to adjust for all of that at the end of the months and things like that. So this is just an extension of these ideas. So we tend to break our cash flows, and cash flow just means what it sounds like, cash flowing into the business and out of the business, okay, into three different categories. The first are called operating activities. These are activities that these are the things that our business does on a day-to-day basis. So this would be things like selling products to customers, buying merchandise inventory from suppliers, paying our normal expenses, wages, utilities, insurance. Those are all our operating activities, the activities involved in the day-to-day running of the business. And so we want to measure our cash that's coming in from that and our cash that's going out from that. Investing activities are activities that involve purchases of assets that will last over multiple financial periods. So again, it's property, plant, and equipment type of stuff, buildings, land, equipment. Those are investing activities. Usually our cash is flowing out for that, right? If we purchase a building or we purchase land, but sometimes we sell off an old asset, right? And so that might actually generate revenue for us, but it's not our normal operating revenue. Like at my business, if I sold off a building, I wouldn't really want to call that operating revenue, because it's not, I'm not in the business of selling off buildings, right? That was a one-time special event that we were selling that building off. So investing activities are any activities that involve the purchase of large assets of property, plant, and equipment, or the sale of property, plant, and equipment, okay? And finally, financing activities, which is any cash flow that's brought in or paid out as a cost of financing, which would mean the issuance of stock or the purchase of treasury stock. Those would all be things that impact our cash flow. The borrowing of money, like a note payable, or the paying off of a note payable, and the payment of dividends to our stockholders. Those are all financing activities. So what will happen is we'll have our cash flow from operating activities, plus our cash flow from investing activities, plus our cash flow from financing activities. Sometimes they're negative, but you're still adding them all up, okay? That will give you your change in cash, and then that should match the change. If you look at your balance sheet for the last 2 years, you can see what the cash was at the beginning of this period, what the cash was at the end of the period, and that difference between the two is your change in cash, and so they should match. In other words, you can look at a comparative balance sheet for 2 years, and you can see what the overall cash flow was, how much cash changed from last year to this year. Doing a statement of cash flows will help us break down how that cash changed. How much of it was due to operations? How much of it was due to investing? How much of it was due to financing, right? Sometimes you will lose money through your operating activities, and so your cash will only be going up because you borrowed. That's an important thing to know, because one person just saying, oh, well, you have more cash than you had before, that doesn't tell the whole story. If I have more cash than I did before because I borrowed money, that's not sustainable over the long term. If I had more cash than I did before because of business operations, because I'm selling stuff and buying stuff and I'm selling more than I'm buying, then that is sustainable. And that's something I want to consider, okay? And then maybe I need to take some of that cash and start paying down my debt. So that's kind of the idea of a statement of cash flows. Let's see. So this is just sort of a graphical representation of the concepts I was just mentioning. So the cash inflows from operating up in the upper left, they usually come from the sale of products to customers or from providing services to customers. And the cash outflows are things like purchasing inventory, paying employees, paying taxes. From investing, we bring in cash from the sale of property, plant, and equipment, from the sale of investments, and cash outflows to buy property, plant, and equipment to purchase investments. From financing, from issuing long-term liabilities, this is where we bring cash in. From issuing stock, from financing, paying dividends to shareholders, repurchasing stock, and to repay long-term liabilities. So I like this slide because it just like in a nutshell is everything I just explained all on one slide. Recognize that most commonly, if we're running a business that's healthy, our operations will have a net positive. In other words, we'll have more cash inflows than we have cash outflows. Our investing will often have a net negative, meaning we'll be having more cash outflows from investing than we have cash inflows. If we're a healthy, strong business, then we're buying property, plant, and equipment. We're expanding and growing. Okay, and then our financing can be either way. Again, financing is a good thing, but you don't want to be overly reliant on it, right? In other words, you know, when is it okay to borrow money? The answer is when it's appropriate. There's not a solid answer. You know, even in your own personal lives, right? If you could buy a junker car that will get you to and from school, and you'll be able to, you know, should you do that, or should you go into debt and buy a reliable car? A lot of it depends on your needs, right? Are you gonna have to be driving to Phoenix a lot? You know, do you have medical appointments that make you go on long drives? You might want something more reliable. If you're 5 minutes from the school and you're willing to take the risks, maybe you don't go into debt. I mean, all those things that are your personal decisions. Do I rent an apartment? Do I buy a home and go into debt for the home? The same things apply in business. But very often I see people investing in property, plant, and equipment too early. And that's actually a killer of businesses. You know, a business you could run out of your house or out of your garage or something until it grows. People are wanting to buy a building, as an example. And you're like, you don't need to start off 300,000 in the hole. It's like starting off a wedding, 5,000 in debt because you bought a $5,000 wedding ring. You know, some people would be like, that's worth it. Most people would be like, let's go a little lighter on the ring so we don't start off in debt, right? But that's something people have to choose. All right, and so it's interesting how often this mirrors, like, we have these real decisions in our regular lives as much as we do in business. All right, so there's two methods that are commonly, I won't say commonly used, there's one method that's commonly used and another method, okay? And we're gonna focus on the most commonly used. So this is the other method, so I'm just gonna very quickly show you what it is. There's a whole appendix on it. There won't be many homework problems on it. There won't be a single exam question on the direct method. Okay, I just want to introduce you to it. It's out there. If you go on and continue studying accounting at the upper division level, take intermediate accounting, and then you'll probably have to dig more into the direct method. I don't know why, because people just aren't using it like they used to in the good old days. If I'm using a computer and I tell it, give me a statement of cash flows, it's going to do it with the indirect method, so that's what we're going to focus on. So this is the direct method, the other method, okay, where it just lists cash received from customers, cash payments for merchandise, cash payments for operating expenses, etc., and it gives you a total net cash flow from operating activities. That's why it's called direct. There's no weird adjustments and other things like that. It just lists them all out. Believe it or not, that seems better because it's more straightforward, but the one I'll show you next, which is the indirect method, has some advantages because what it does is it starts with our net income and then we make adjustments to net income to get to our cash flow. The net cash flow at the bottom of both of these, using either method, direct or indirect, is the same. Okay, it's just how they get there that's different. So this is the direct method. It's just not used nearly as much as it used to be. So we'll focus our energy on the indirect method. So what we do with indirect method is we start with net income, and then we make adjustments to reconcile our net income to net cash flow, and that will give us our net cash flow from operating activities in that first section. So this kind of compares the two side to side. You can see the direct method just says, hey, here's the cash we received from customers. Here's the cash we paid for expenses and to our creditors. That's our net cash flow from operating activities. With the indirect method, we say, hey, we started with net income. We change for increase in accounts payable, change for our increase in supplies. That gives us our net cash flow from operating activities. Again, this seems easier, but in the end, indirect yields us more valuable information, which is why most businesses have switched to using that method. And under generally accepted accounting principles, I would say I believe direct method is still allowed, but indirect is kind of the preferred method. All right. We'll skip past that. All right, so let's get to this. This is what a statement of cash flows is going to look like, the format of it, using the indirect method. It's always going to be in this order: cash flows from or used for operating activities, cash flows from or used in investing, cash flows from or used in financing. OIS, operating, investing, finance, or OIF, and financing. That's the same order. They're always in when you see them, okay? I'm gonna skip that too. I wanna get to how we do it. All right. All right. So here's an income statement for the Rundell Corporation for 2018. We can see that they had sales of 1.18 million. So a good year for Rundell. Cost of goods sold, 790,000. Gross profit of 390,000. Operating expenses, other expenses, net income of 108,000. Okay, so this would be a good, solid income statement for a small business. This is what you'd see for a lot of small businesses. This is why people think small business owners are rich, because they think they're getting this much, but they're really only getting this much, which is a good, solid income, but not rich, right? People are always like, you made $1 million last year. No, I sold $1 million worth of stuff, but it had cost of goods sold of almost 800 grand right there, right? It's an interesting thing. People always accuse my mom of being rich. And like, you have a Cadillac. She's like, it's a 1983 Cadillac. Okay, all right. So there's their income statement. Here's a comparative balance sheet. So comparative balance sheets typically have multiple years on the columns. And typically will show the newest or most recent year in the left-hand column, and then they get older, and then there'll be sometimes like a comparison, right? An increase or decrease between the two. So right off the bat, we can see that Rundell's cash increased a lot, right? It went from 26,000 up to 97,500 from 2017 to 2018. And so as the accountant, I started asking myself, wow, that's quite a bit for a company this size. What's that about, right? Like your mind starts asking, how did the cash go up? Their accounts receivable went up, their inventory went down, their land went down, buildings went up, their total assets increased by about 80,000. If you think about that, I mean, their cash went up 71. So that the cash accounts for a big chunk of that increase. Their liabilities, accounts payable went down, accrued expenses went up, income taxes went down a little, income tax payable, dividend payable went up a little, bonds payable, so went down a little. So not only did their cash go up, but they've paid off debt. They have 47,500 less debt than they had. I'm liking their financial position right now. There's good things happening, but did they fund it? How did they fund it? So let's look. Their stockholders' equity went up a little. Paid in capital in excess of par went up, so they did issue some stock. That will account for some of the cash they probably have. And their retained earnings went up. Remember, retained earnings goes up with net income, goes down with dividends. So their net income exceeded the amount of dividends they paid out by $80,000 last year. Okay, so you could tell a lot from a comparative balance sheet. Actually, our financial management course focuses on just looking at these statements and saying, what does this tell us about the business? What intelligent questions can we ask about the business from this? Okay. All right. So here's how we go about creating a statement of cash flows. This is what you're going to really need to know. Okay. Here's the meat of this chapter. So we start with the net income. We had a net income of $108,000. We notice it does not equal the cash flows from operating activities, right? It was different. So what's the process we use to create a statement of cash flows? So the first thing we do, this is where it gets a little bit hard. We start with our net income, and then we do these adjustments to reconcile net income to net cash flow. The first adjustment is to add back in any non-cash expenses. Okay, so that's our step one. So what I mean by that is we have expenses on our income statement. If we look back at their income statement, like depreciation expense, that reduce the net income, but they would not have reduced cash. Does that make sense? Because depreciation expense is just a recognition of expense on an asset that was purchased previously. Okay, so our first step is to add back in any depreciation on fixed assets or amortization of intangible assets. So that's step one. That's our first entry, or our first to reconcile net income to net cash flow. Step two is we're going to add in any losses on disposal of assets or any gains on disposal of assets. So any money we made by selling off assets like buildings or land or something like that, that's going to get picked up later in the investing activities section. So if we count it up here in the operating activities section, it's going to double count. Okay, because recognize when we sell off a piece of property, if we make a gain on it, that's going to increase our net income. But it's not really an operating activity. It's not what we do day to day. So we're going to record that gain later on in the cash flow statement down in the investing section. So what we do is if we had a loss on disposal of assets, we add it back in. And if we had a gain on disposal of assets, we subtract it out. That's step two. Step three, we do adjustments for changes in current operating assets and liabilities. We recognize that as our operating assets and operating liabilities, which means our current assets and current liabilities, as they change, that's going to impact our cash flow. Okay, so here's the rule. I'll explain why, but if explaining, sometimes the explanation why, it's easy for me in the first few years of me doing this, and then the first few years of teaching it, to talk myself into a circle almost. But I want to explain why. Here's the rule though. When we're doing this step three, adjusting for changes in current operating assets and liabilities, changes in assets are going to have an opposite adjustment. And changes in liabilities are going to have the same adjustment. And here's what I mean by that. If I have a current asset increase, so if my accounts receivable increases, I'm going to adjust my cash down for that increase. And what I mean by increases is increase from last year to this year. Here's why. If my accounts receivable goes up, okay, that means that customers who owe me money last year, I now have more people owing me money. What it really means is the things I recorded as revenue from selling people, I didn't collect all of that, okay? In other words, if I sold $100,000 worth of stuff to people and I collected $100,000 worth of from the people, then my accounts receivable would remain unchanged from last year to this year, right? If 10,000 was owed to me, I sold 100,000, collected 100,000, 10,000 would still be owed to me. If the amount that's owed to me goes up, it means I didn't collect all of my sales in cash this year. So I'm going to make an adjustment to cash that's down. It means more is owed to me, so I didn't collect it all in cash. If my accounts receivable goes down, it means I collected everything from what was owed to me this year, plus some of the stuff that was owed to me previously. So I've got more cash than I would have had. So that's the reason why. But if you can't remember why, then just remember assets opposite. If an asset goes up, I'll adjust my cash down. If an asset goes down, I'll adjust my cash up. Okay, so remember the rule first, and then learn the justification or the reason behind it second, and you'll be all right. With current liabilities, it's the same. So if the liability goes up, I'm going to adjust my cash up. And if the liability goes down, I'll adjust my cash down. The logic behind this is, so consider accounts payable, okay, money owed to my suppliers. If I buy stuff from suppliers and I pay for it completely, then my cash flow would equal the expense I paid to the supplier, okay? If I bought stuff from a supplier and didn't pay for all of it, then my accounts payable would increase, right? Because I would owe more, okay? And so my cash would also increase because even though it's listed as an expense, I didn't pay for it all yet. I haven't paid that money out. So that's again, and it's easy as for me at least, as I start to try to justify why, to start to get into the circular reasoning and be all confused. So if you start to feel yourself getting confused on it, just apply the rule. Assets opposite, liabilities the same. And the reasoning will come as you do more of it. Or if you never have to do more of it, if you're like, this is all the accounting I'm taking because I'm a marketing major when I get into the university, good. You don't have to worry about it. Let the accountants deal with that, right? All right. So let's see. So I'm going to go back real quick and just show you what I mean. So here we are looking at Rundell's comparative balance sheet, and we can see their accounts receivable increased by $9,000. You can see their inventories decreased by $8,000. Their land, which is not a current asset. So when we're doing our operating, our adjustments for operating, or not our adjustments, our operating cash flows, we're going to start with our net income. So our net income was $108,000. That was step one. Step two, we'll add back in any non-cash expenses. So on this one, we see there's a depreciation expense of $7,000. Step three, we're going to subtract out any gain on a sale of land or add in any loss. So we had a gain on the sale of land, so we're going to subtract that. And then we're going to make these adjustments for the changes in our current assets. So if my accounts receivable went up by 9,000, I would say assets opposite. So cash would go down 9,000. Inventories went down by 8,000. Assets are opposite, so I'm going to adjust my cash up by 8,000. Then I looked at my current liabilities. Accounts payable went down by 3,200. Liabilities the same, so I'm going to adjust my cash down 3,200. Accrued expenses went up by 2,200. Since that's a liability going up, I'm going to adjust my cash up. Income taxes payable went down by 500, so I'll adjust my cash down by 500. Dividends payable went up by 4,000. I'll adjust my cash up by 4,000. And bonds payable is long-term. So it's just for the current assets, current liabilities. So now if I total all this up, net income plus 7,000 for depreciation minus 12,000 for the gain on the sale of the assets, all my adjustments for changes in my current assets and current liabilities, that total is going to be my cash flows from operating activities. Okay. It's a little confusing and it takes practice. Okay. It'll come together as you do more of it. That's the process. This is just spelling out the steps again. In fact, I'll read through it one more time. Okay. So our adjustments to net income, step one, expenses that do not affect cash are added. Such expenses decrease net income, but do not involve cash payments and thus are added to net income. Almost always that's depreciation expense. Not that many businesses have a lot of intangibles like patents and stuff. And so the most common is just depreciation. Okay, you're just adding depreciation back in. Step two, losses on disposal of assets are added. Gains on the disposal of assets are deducted. Why? It's not that they're not important, it's that they're not operating activities. We're going to handle them down in the other section. So we're just going to pull them out of there by adding them back in a loss or subtracting out a gain. And then step three, the adjustments for operating assets or for changes in current operating assets and liabilities. Again, assets opposite, liabilities the same. So I've repeated that 3 times through. That's your signal that this is important to remember, right? Why does the teacher keep repeating himself? I think maybe he has Tourette's or something. I don't know. I'm like, no, Tourette's is like tics. It's not repeating. That's a different thing. What's that? Yeah, it's a hint. You stomp your foot and be like, listen to this part. Okay. All right. So there they are. They just walked through what I just wrote up on the board. Okay, same exact thing. If you take a look at it, it's even the same numbers. Started with 108,000, add the depreciation 7,000 back in, subtract out the 12,000. Then we do for our changes, subtract out 9,000, add 8,000, subtract 3,200, add 2,200, subtract 500. So the net cash flow from operating activities, $10,500, or I mean $100,500. That's actually pretty close to their net income, right? They brought in $100,500. So now once we do that, that's the end of the operating, the first section of that statement of cash flows. That's the hardest section, by the way. It's the longest and most involved. So now we're ready to move on to our investing activities. So we can take a look at the changes. So there was a $45,000 decline to the land account. We can take a look at the transactions and see, like the land account had $125,000 balance at the beginning of the period, and it had an $80,000 balance at the end of the period. In other words, it changed, it went down $45,000. We can look back at the transactions and say, oh, look, we sold some land. And remember, when we sell land, what we're recording under the land account was its cost. So we sold land with a cost of $60,000, and then we purchased $15,000 worth of land. And so that's our net of $45,000 in decrease in our land account. So there's our cash received from the sale of our land. Then we purchased $15,000 in land. We also had a change in our building account. It increased by $7,000. So we can take a look at how it was 200,000. We had a purchase. Now it's 260,000. And that we applied, oh, I'm sorry, it increased by 60,000. And then our accumulated depreciation account was a $7,000 change. Again, that's an outflow from investing activities. So I thought it would have a, it doesn't show that part of it yet. So we'll see it at the end. So let me look back at it real fast and show you that so from our investing activities, We received $72,000 from of cash from the sale of our land. We paid out $15,000 from the purchase of land. And then we received $60,000. Oh no, we paid out $60,000 for the purchase of building, and we had the $7,000 depreciation. And I'll show you when we get to the end and we see the full statement of cash flows, how that looks on the statement of cash flows. So finally, the financing activities. Recognize the same rules apply in a sense, which is if our asset goes up, if a piece of land goes up, then we're going to assume cash went down. We had to buy that cash. And we're like, how do you know if you paid cash for it or if you financed it? Well, that'll come out in the financing section. So the basic assumption is if an asset increases, cash decreased. And if assets go down, then cash went up because you got to pay for it somehow. Okay. So here we see that they issued bonds. Issuing bonds is the same as borrowing money. Okay, so, oh no, so they didn't issue bonds. They retired, they paid off some of their bonds because the balance was 150,000. And now at the end of the period, the balance is 100,000. So here's a liability. The liability went down. So the assumption is cash went down, right? They must have paid that off with some cash. So cash paid to retire the bonds, $50,000. Common stock had a balance of 16,000. And then at the end of the period, it had a balance of 24,000. So when we issue stock, our cash goes up. Paid in capital in excess of par had a balance of 80,000. At the end of the period, it had a balance of 120,000. So we brought in some cash by issuing stock. So $48,000 total. And then our retained earnings started at 10,000. At the end, it was 14,000. So let's look at the statement of cash flows. I think sometimes by breaking it all down, it seems more confusing than it really is. So here's that operating section we started with. Started with net income of 108,000. Then we had our adjustments to reconcile net income. We added depreciation, subtracted out that gain on the sale of the land. Then we made our adjustments for the changes in current operating activities and liabilities, which gave us a net cash flow from operating of 100,500. We received $72,000 on the sale of the land. We paid $15,000 for another purchase of land and paid $60,000 for buildings, which means our net cash flow used from investing activities was 3,000 or a negative 3,000. We paid out 3,000 more on investing activities than what we brought in. Finally, on investing, we received 48,000 from the sale of common stock, paid 50,000 to retire bonds, paid 24,000 in dividends. So our net cash flow from financing, negative 26,000. So we add all that up, we have a net increase of cash of 71,500. So the business has $71,500 more cash today than it did at the beginning of the year. Where did it come from? Well, it actually came 100,500 from operating, and we actually paid down in these other two sections. And then we would say, do these things add up? If I had 71,500 in total cash, and I add that to my cash at the beginning of the period, it should add up to my cash at the end of the period. Okay. So that's the process. And like I said, it's a hard chapter. I sense from your quietness that you're like, I'm going to have to look at this more and think about it more, right? And that's okay. It's got a little bit of challenge to it. Couple of measures we use. One is called free cash flow. Free cash flow is pretty much just the cash we make from our operating activities minus any cash we use to purchase property, plant, and equipment. What that means is our cash flow that we can actually use for other stuff. So, so sometimes that's even negative, right? If you purchase more property, plant, and equipment than you brought in from operating activities, that'd be a negative free cash flow. Sometimes you don't buy any property, plant, and equipment. So all of your cash that you bring in from operating is free cash flow, able to be used for other operating needs. Anyway, so just cash flow from operating activities minus cash used to purchase property, plant, and equipment gives you free cash flow. Okay, that's the formula for that one. And that's it.